Hi, I'm Glenn Gimbel, and this is my colleague Elizabeth Khalil. When underwriting a loan that is not a qualified mortgage, creditors must consider the following 8 factors and verify the information used in making the credit decision using reasonably reliable third-party records. Before we go through the 8 factors, let's talk about what is meant by reasonably reliable third-party records. The ATR-QM rule itself and official commentary have an illustrative list of examples. And it's important to note that despite the name, third-party record includes some of the creditor's own records for accounts it holds for the consumer. It can include such records as savings accounts, retirement accounts, and so on that the consumer has with the creditor. So even though the rule calls the records third-party records, many of the bank's own records can be used.
Now on to the 8 factors. Again, the ATR rule does not limit the types of features or terms that may be in a non-QM loan. Instead, the focus is on making sure that the loans are sufficiently underwritten. So non-QM loans must consider each of the following 8 factors where applicable. You'll notice that all 8 of these factors relate to common sense underwriting. You probably considered these factors when underwriting loans before this rule became effective. Here are the 8 factors. The first factor is the borrower's current or reasonably expected income or assets other than the value of the dwelling securing the loan. We know there's been some uncertainty about whether you can qualify a loan based on assets and not on income. The answer is yes, you can, as long as you do so based on assets other than the property securing the loan. Of course, those assets must be verified as well. The second factor is the consumer's current employment status, if the creditor relies on income from the consumer's employment. The third factor is the monthly payment on the loan. This factor refers to the principal and interest payment. The monthly payment you consider when making the ATR determination may not always be the payment called for in the contract. There could be different monthly payment amounts depending on the type of loan. Adjustable rate mortgages, for instance, can have payment amounts that change.
Let's take a minute to understand which monthly payment to consider. For fixed-rate, fully amortizing loans with substantially equal payments, you would use the monthly principal and interest payment called for in the contract. But for a loan where the payments are unequal or might change, the rule mandates specific assumptions to be used in calculating the payment amount to use here. This will be relevant for loans like adjustable rate mortgages and balloon loans. We'll touch on some of those assumptions in a bit more detail in segment 8. Just know for now that the rule does guide you in what payment amount to use. The fourth factor is the monthly payment on any simultaneous loan that the creditor knows or has reason to know will be made. This means loans secured by the same dwelling. So, the payment on so-called piggyback loans should be factored into your consideration of the ability to pay, if you know or have reason to know of it. This is necessary whether you or some other creditor is making that simultaneous loan.
The fifth factor is the monthly payment for mortgage-related obligations. Mortgage-related obligations are property taxes, premiums, or insurance required by the creditor, including hazard and mortgage insurance, condominium assessments, and similar recurring charges. These must be considered regardless of whether there is an escrow account. The sixth factor is current debt obligations, alimony, and child support. You can keep in mind that the rule specifically gives you some flexibility here as to how to consider these obligations. The official interpretation in the ATR-QM rule says that creditors have significant flexibility to consider current debt obligations in light of attendant facts and circumstances, including that an obligation is likely to be paid off soon after consummation. The seventh factor is the monthly debt-to-income ratio, DTI, or residual income. Residual income is the amount of monthly income that would remain after subtracting the consumer's monthly debt obligations.
Please note that this does not mean that you have to keep to a specific DTI limit, For non-QM loans, there is no specific DTI limit. Instead, the ATR rule leaves it up to the creditor to make a reasonable and good faith determination of what an appropriate threshold is for DTI or monthly residual income. Finally, the eighth factor is the consumer's credit history. Keep in mind here that this does not require creditors to obtain or consider a consolidated credit score, such as a FICO score. Also, the rule specifically says that you are allowed to look to non-traditional credit references, such as rental payment history or utility payments, though you are not required to do so.
Again, these factors are all related to common sense underwriting principles. In fact, many bankers say that these 8 factors are very close to the underwriting factors they've traditionally used. You'll also notice that there is a lot of flexibility in these rules for you to set your own standards. For example, your use of DTI and credit history can be tailored to your particular institution's underwriting risk threshold, so long as the bottom line is that you make a reasonable determination of the consumer's ability to repay according to the loan's terms. And again, there is no ban on any specific type of term or feature in a non-QM loan. For instance, there's no prohibition on balloon payments in non-QM loans. You can write a non-QM balloon loan. Under the rule, the only special provision you need to think about for non-QM balloon loans is how to figure out the amount of the monthly payment to use in your underwriting consideration. Check the rule for those instructions.
Before the rules were implemented, we were hearing some concerns from institutions about whether they could still make the types of loans they were used to making and still be in compliance with the ATR-QM rule. We hope this makes clear that, as long as there is responsible underwriting, the answer is yes. You may find that your practices are essentially already in compliance, though you might need, for instance, to document those practices a little more extensively than before. We'll discuss some suggestions for your policies and procedures regarding documentation in segment 8 of this video. Next, we will discuss the qualified mortgage presumptions.